Before we begin, a quick disclaimer. This video is for educational purposes only and does not constitute financial advice. Trading involves risk, and past performance does not guarantee future results. Many traders spend a lot of time searching for the perfect entry signal. They test different indicators: MACD, RSI, supertrend, moving averages, or different candlestick patterns. Sometimes these signals appear to work well, but other times the exact same signal produces very different results. So the question becomes, why does the same signal sometimes work and sometimes fail? In many cases, the issue is not the signal itself. The issue is the market context surrounding the signal. Without the right structure, even a good signal may produce inconsistent results. In this video, I want to introduce a framework that helps organize this context in a more systematic way. It is called the DLT 2.0 framework. Overview of the DLT 2.0 framework. DLT stands for 3 layers of analysis: direction, location, trigger. These layers describe how a trading idea can be structured from a top-down perspective. Layer 1 focuses on the macro environment of the market. Layer 2 focuses on a higher timeframe strategy setup. Layer 3 focuses on the execution timing on a lower timeframe. When these layers align, the trade setup becomes more structured and easier to evaluate. The framework does not predict the market. Instead, it helps organize the decision-making process. Why entry signals alone can be unreliable. Many trading approaches focus primarily on entry signals. For example, a bullish engulfing candle, an RSI oversold signal, a MACD crossover, a breakout above resistance. These signals can sometimes lead to good trades. However, their performance often depends heavily on the surrounding market conditions. A breakout signal during a strong trend may perform very differently from a breakout signal during a sideways market. Similarly, a reversal pattern near a major support level may behave differently from the same pattern appearing in the middle of a consolidation range. Without understanding the broader context, it can be difficult to evaluate whether a signal has a reasonable probability of success. This is where a structured framework becomes useful. Layer 1. Direction. Macro environment. The first layer of the framework is direction. Direction focuses on the broader market environment. Professional investors often consider macro factors when evaluating markets. Examples include interest rate trends, inflation expectations, currency strength, liquidity conditions, global risk sentiment. These factors can influence the behavior of different asset classes. For example, the gold market may respond to changes in real interest rates and US dollar strength. Equity markets often respond to central bank policy, economic growth expectations, and earnings outlook. Cryptocurrency markets may also be influenced by liquidity conditions and investor risk appetite. The goal of the direction layer is not to generate trade entries. Instead, it helps identify the general market environment or bias. Understanding the environment can help traders decide whether it may be more appropriate to focus on long opportunities, short opportunities, or sometimes remain patient. Direction example. Let's look at a practical example of direction. Imagine we are analyzing the broader macro environment. Central banks around the world begin lowering interest rates. Liquidity conditions start improving. Risk appetite in financial markets begins increasing. Historically, expanding liquidity has often been associated with stronger performance in certain risk assets. These may include markets such as equity indices, technology stocks, or cryptocurrencies. In this type of environment, a trader might develop a bullish directional bias toward these markets. Now notice something important. At this stage, we are not trying to predict exact price movements. We are not saying price will go up tomorrow or that a specific entry signal will work. Direction simply answers one question: if we are going to take trades, which side of the market do we prefer to focus on? For example, if the broader environment appears supportive for risk assets, A trader might focus primarily on long opportunities while ignoring many short signals. This can help traders align their analysis with the broader market environment. Because one of the most common mistakes traders make is trading against the broader market context. However, direction alone does not produce a trade. It simply helps define which side of the market we prefer to analyze. And that leads us to the second layer. Layer 2. Location, higher timeframe strategy. The second layer is location. In many trading discussions, location is described as a price area. Examples include support and resistance levels, supply and demand zones, order blocks, liquidity areas. These ideas can be helpful, but they can also be subjective. Different traders may define the same zone differently. In DLT 2.0, location is defined in a more systematic way. Instead of focusing only on zones, location can be defined by a higher timeframe strategy setup. For example, a trader might analyze the market on a 4-hour or 1-hour chart and apply a specific strategy. Examples might include an EMA pullback structure, a supertrend continuation pattern, a Donchian breakout structure, a VWAP pullback, or certain price action patterns. When a higher timeframe strategy identifies a potential setup, the market is considered to be in a meaningful trading location. This approach can be particularly useful for systematic or algorithmic research because the rules can be clearly defined and tested. Location example. Let's look at a practical example of location. Imagine the broader market environment is already supportive for risk assets. Now we move to the second layer of the framework. We analyze the market on a higher time frame, such as the 4-hour chart. Suppose the market has been trending upward. Price remains above a long-term moving average, suggesting the trend structure is still intact. After a strong move, the market begins to pull back toward the moving average. This pullback represents a potential structural setup. If the higher timeframe strategy defines this pullback as a valid pattern, the market can now be considered to be in a meaningful trading location. Notice something important. We still have not entered the trade. The higher timeframe structure simply tells us that the market may now be in a suitable position to consider a trade idea. The actual entry will still depend on the third layer of the framework, which is the trigger. There is another important point about location. The higher timeframe setup must be aligned with the direction layer. If the higher timeframe structure conflicts with the broader market direction, the correct action is often to wait. In other words, no trade. For example, imagine the macro environment suggests a bullish bias, but the higher timeframe structure shows a strong bearish continuation pattern. In this situation, the location layer is not aligned with the direction layer. When that happens, the framework suggests that traders should remain patient rather than forcing a trade. This is why some traders are sometimes described as sniper traders. They may wait for extended periods of time until the market structure aligns with their framework. Instead of reacting to every signal, they wait for conditions that fit their trading model. Sometimes that waiting period can be quite long. In certain market environments, a suitable setup may not appear for weeks or even months. But the goal of this approach is not to trade frequently. The goal is to act only when the market structure matches the framework. And once the direction and location layers are aligned, the trader can then move to the third layer of the model, which is the trigger.
Layer 3, trigger, execution. The third layer is trigger. Once direction and location have been evaluated, the next step is determining the timing of execution. The trigger typically occurs on a lower time frame. For example, 15-minute charts, 5-minute charts, or sometimes even shorter time frames. At this stage, the market has already passed two filters, the broader market direction and the higher time frame setup. The role of the trigger layer is simply to define when the trade should be executed. The exact form of a trigger can vary depending on the strategy design. Some strategies may look for momentum shifts on a lower time frame. Others may use indicator confirmations, such as a faster signal aligning with the higher time frame setup.
In some cases, the trigger may involve minor structure events, such as a break of a recent short-term high or low. There is no single universal trigger. The appropriate trigger usually depends on the logic of the overall strategy. Interestingly, the strategies used in different layers do not always need to be different. In some systems, the same concept may appear across multiple layers. For example, a trader might use a slower trend indicator on a higher time frame to define the setup and a faster version of the same indicator on a lower time frame to define the entry trigger. In other systems, the layers may use completely different logic. A higher time frame trend strategy may define the setup, while a lower time frame momentum signal defines the execution. Regardless of the method used, the objective of the trigger layer is to refine entry timing once the broader structure of the trade has already been established. Trigger example. Let's look at a practical example of trigger. Once direction and location are aligned, the final step is execution. At this stage, the broader market environment supports a particular bias and the higher time frame strategy has already identified a valid setup. Now the objective is simply to determine when to enter the trade. This is where the trigger layer becomes important. The exact form of the trigger depends on the strategy design. For some approaches, the trigger may involve a momentum shift on a lower time frame. For example, a momentum indicator turning from negative to positive. In other cases, the trigger may involve a structure event, such as a break of a recent minor high or low. Some strategies may use indicator confirmations, while others may rely purely on price structure. In systematic trading research, there is no single universal trigger. Interestingly, the strategies used in different layers of the framework do not always need to be different. In some systems, the same concept may appear in multiple layers. For example, a trader might use a slower trend-following indicator on a higher time frame to define location, and a faster version of the same indicator on a lower time frame to define the trigger. In other systems, the layers may use completely different types of logic. For instance, a higher time frame trend strategy may define the setup, while a lower time frame momentum signal defines the entry timing. Regardless of the method used, the purpose of the trigger layer is to refine the timing of execution once the broader structure of the trade has already been established. Example of the framework. Let's walk through a simple example. Imagine we are analyzing the gold market. First, the direction layer defines the market environment. Macro conditions may suggest a particular market environment based on factors such as interest rate expectations or currency movements. Next, the location layer identifies a higher time frame setup. On a 4-hour chart, a strategy might identify a pullback toward a moving average structure. This pullback may represent a potential setup area. Finally, the trigger layer determines the execution timing. On a lower time frame, the trader or system waits for confirmation, such as a momentum shift or a break of a small price structure. Only after these conditions align does the trade become a structured setup. The goal of the framework is not to predict the market, but to structure the decision process. In many ways, the DLT framework is less about prediction and more about structure. The DLT 2.0 framework is not designed to predict markets. Instead, it provides a structured way to think about market analysis. Direction helps understand the broader environment. Location identifies higher time frame setups. Trigger refines the timing of execution. By organizing trading decisions into these layers, it becomes easier to evaluate setups and study different strategy ideas in a more systematic way.